Hi, I'm Chloe Carruthers here with Barry Norris, the fund manager of the Argonaut Absolute Return Fund, here for our March update. Barry, it was another tumultuous month for markets. How did the fund perform and what were the main drivers of performance?
Certainly was tumultuous again, Chloe. So the fund was up 1.5% for the month, approximately now 11% for the year and 65% over 3 years. Again, the fund had a very low, in fact, negative correlation to the market. We made money on our long book primarily through our commodity exposure, but we lost money for the first time in 6 months on our short book, something we'll talk about a bit later. So although the fund was up, it was a bit more complicated than some of the months that we've had previously.
Your prediction of a return to the 1970s, which you made last year, seemed to come true during the month, but the market rallied. Why was this?
Yes, so certainly outlawing Russia from the global economy has certainly accelerated the 1970s redux in terms of deglobalization, stagflation, and the commodities bull market. So I think, it's fairly strange that the market decided after, a difficult first week to rally quite hard off that, with some of the more speculative pockets of the market that you would have thought would do least well in a stagflationary environment, namely profitless growth, really leading the charge. And I think you can attach a number of narratives to that. Firstly, I think the rhetoric from the Federal Reserve was much more hawkish during the month. Perhaps there are people that think that the Fed is finally getting ahead of the curve and will be able to kill the cycle. We, of course, think the drivers of inflation are far more structural than that, and interest rates would have to go to a politically unacceptable level to really kill the inflationary cycle. Perhaps people think that the war in Ukraine will be over quickly and Russia will be welcomed back into the Western economy. We doubt that. Obviously, a lot of tech stocks have fallen a long way, particularly the speculative stuff, and maybe there's just too tempting for people to think that those are now cheap. We don't think there's any valuation support. And then finally, as we've seen in previous eras of very high inflation, equities can be a less bad place to be than cash or bonds, and perhaps benefited from some flows in that regard. But our view is that this rally will fail, but perhaps not until complacency becomes consensual again.
Did you make any changes to your portfolio during the month or as a result of the Ukrainian war?
Well, the outbreak of the war saw initially very strong performance from our commodities element in our long portfolio, but then that became quite uncorrelated to the market. So we had days where the market would go up when commodity prices fell, and vice versa. So that meant that the correlation of the fund to the market actually became much more negative than what we considered desirable, and therefore we actively managed the portfolio in terms of reducing the size of some of our short positions so that we didn't become overhedged against the market. So as a result, our net exposure went from 25 to 65%. And if you think of that ratio of longs to shorts, it's roughly 2 to 1. And if you think that, roughly half of our long portfolio will have some commodity element to it, if that commodity element is going to be already uncorrelated to the market, our view is that we're over-egging the pudding by hedging that with our short book. So if you think at the moment, £2 on the long book compared to £1 on the short book, and £1 of that £2 on the long book is unhedged, and so you therefore got, if you like, £1 of stock-specific risk being hedged with £1 of risk on the short book as well. So I think that should make our returns a little less volatile while still being uncorrelated to the market.
Talk us through why you're bullish on commodities relative to your bearish views on the rest of the market.
Well, I think it's now clear that the pricing power has swung from innovators, if you like, to commodity producers. And that's partly because all the capital over the last 10 years has been available to innovators and very little to commodity producers. So if we think about electric vehicles, now every manufacturer of electric vehicle is supply constrained by semiconductors or availability of industrial metals like nickel or lithium. So every EV manufacturer will probably warn on sales volumes and on their gross margins. And the cost of EV, because of this, means that unless governments subsidize electronic vehicles, probably those are going to be unaffordable for most people. It's just going to be a niche product that those who have already or can afford to buy one and want one have already bought. So if we look at sort of electronic vehicle manufacturers, they have high valuations, quite easy access to capital still. But the bottleneck in terms of the EV revolution, if you like, is actually access to the raw commodities. And those will remain supply constrained for quite a few years to come, simply because it takes a number of years to bring on new mine capacity. And the market is just beginning to work this out. So the choice for us as an investor is pretty simple. Would you rather pay 50 times profitless sales to buy an electronic vehicle manufacturer, or would you rather pay 3 times earnings to buy, let's say, a nickel miner on 3 times earnings with no debt? And I think that single illustration just, I think, highlights where we see the opportunities now.
Every fund manager nowadays seems to be very keen on ESG. Have you got any plans to change your fund names to incorporate the sustainable moniker?
Well, that's a cheeky question, Chloe. As you know, we've been quite skeptical on ESG. It's not that we believe in unethical investing. It's just that ESG in its current form is incredibly simplistic and imposes these groupthink rules that are quite arbitrary on investors and on companies. And it really wasn't a good month for ESG. I think it's clear that there are now more immediate concerns to human life than those political aspects that ESG has hitherto focused on, like climate change and race and identity politics. And if we think about some of the things that happen in the month, it rather highlights how arbitrary some of the ESG rules have been. So overnight, defense stocks in Europe went from being the living embodiment of Satan to essential to the social fabric of Western civilization. And you would have thought somebody might have worked that out beforehand. Germany fired up its coal plants again. President Biden is now encouraging American oil and gas companies to get drilling and fracking again, though in many ways is still quite obstructive to that. The US has also offered to build Iran a couple of nuclear power plants if they'll help out on oil supply, which seems a very odd moral choice compared to just starting up and accelerating US drilling. And I think what we've seen so far from governments is the solutions that they've come up with to the energy crisis have been pretty underwhelming, and it's just more of the same alternative energy. That's not going to make a difference for a number of years, and as we've noted, creates a different quality of energy to fossil fuels. And so on both of these aspects of the energy crisis, the price of energy and its reliability, but also security, governments and ESG have shown themselves to be distinctly lacking.
Why are you bearish on renewable energy companies?
Well, I think it's very consensual that these companies are the solution to the energy crisis and are somehow inevitably the future. And I just disagree with that. The first thing which is most obvious to me is if you look at power prices in the UK, there's no such thing as an average price. The price fluctuates from being very high to negative at times. And when it's negative, that's because the wind's blowing. So it just seems to be crazy to think that when we already have a glut of cheap power when the wind is blowing, why we need to invest in more wind. So we have an even bigger glut of power, which is subsidized by taxpayers when the wind is blowing. It's just utterly crazy. It's utterly useless. And environmentalists should be up in arms about the fact that we're building all this useless wind production, using up all these resources to build something that really creates no economic value and damages the environment. It's a little bit like a factory owner paying a premium to hire workers who guarantee to turn up at the wrong time, and for workers to never be there when they're needed. It's just totally unproductive capacity. And I think, in addition, I think that, if we think that the cost of fossil fuels has gone up because we haven't invested in them, then it's also true to say the cost of wind energy is also going to go up because of inflation in commodity prices, and also interest rates going up means that wind utilities can't build the wind farms as cheaply as they used to do. So, to our mind, wind and solar have in Europe already surpassed their useful market share. And I think it's worth considering that in the UK, we've already halved our carbon emissions from switching off coal and replacing it with natural gas. And it seems to me that at the moment, I think the pace of decarbonisation is becoming unaffordable and frankly illogical.
Why do fossil fuels have a future?
Well, I mean, the most obvious reason is that the developing world is never going to stop using them. So if we think roughly there's 8 billion people on the earth at the moment, just over 1 billion of those live in Europe and North America. And those are the only countries that are obsessed by decarbonisation at the moment. So demand in the rest of the world, where most people live, is still going to be there. Secondly, I think that it's going to be very difficult to replace fossil fuels in the role that they provide to Western economies, both in terms of their historic cheapness, but also reliability. So let's think at the moment, what's going to power electricity grids when the wind isn't blowing? And we've already obviously talked about the costs of storage and the scalability just not being there. You have to have an energy source which switches on and off when the wind's not blowing, and only gas-fired plants can do that. Even things like nuclear, you can't, once you've got them up and running, you can't switch them on and off. So gas-fired power is really here to stay, and we should put it into context that gas has half the carbon emissions of coal, and it has roughly 30% of the emissions of wood pellets, which are currently 10% of UK power generation and subsidized by the government. So a lot of that is just completely illogical. Let's think about electric cars again. To our mind, the resources and the cost simply doesn't exist for everybody to be driving an electric car. So we'll continue to need internal combustion engines. And the idea that in the UK, we're going to stop selling internal combustion engine cars in only 8 years, to my mind, is pretty fanciful at the moment. And just, decarbonisation, I think, is proving to be now much more unpopular when people, for the first time, are having to consider the cost of decarbonisation and not just some of the stated benefits. And if we think about why invest in fossil fuels, one, because we need cheap energy, two, we need reliable energy, and three, we need energy that is not controlled by the Russians or OPEC. And I think, therefore, it's our moral duty to invest in fossil fuels. And if you consider that the industry is valued as a sunset industry, then obviously, if it turns out that I'm right and fossil fuels are very much part of our future, then they'll be the best place to invest in the market over the next decade.
What would you say the fund offers investors, which most other equity funds do not?
Well, look, I think most investment products are just very highly dependent on market direction, whether that be passive funds, which is obviously buying beta cheaply, or actively managed funds, which aim to beat the market, but still go up and down at the same time as the market. And therefore, what we offer is something distinct in that our return profile is totally uncorrelated to the market. And therefore we blend well with other strategies. And we've never said, people should put all their money in one fund. In fact, we'd actively discourage that. But I think when you look at our return profile, which has been double-digit uncorrelated returns, that blends fantastically well with funds that are more correlated to the market direction. And therefore, whilst there are people that will agree with us that we're going back to the 1970s, I think that you actually don't have to be as bearish as that to appreciate some of the diversification benefits and the insurance policy, if you like, that the fund gives you against less benign outcomes. And I think that's obvious what the fund offers people, and therefore we would very much encourage people to see the fund as part of a diversified overall portfolio.
Great. Thanks very much for your time, Barry.
Thanks, Chloe.